Thank you, Arthur.
Hello, welcome everybody. Thanks for joining us today. We're super happy to have a real estate opportunity with you, and thanks for RSVPing and joining us, and, as you often do. And uh, if there's somebody that you know that would also be interested in this after you hear what you hear today, you're welcome to be in direct contact with Tom and Jake, and we'll make sure we make that happen, as well as we'll have this recorded and provide that link so you can share it with others. So just be aware that there's no prohibition in you making sure that if there's others that are interested, in addition to what your interest may be, you're welcome to do that directly. So, and again, thank you for everybody. We have a structure here as usual where we know you're there, but we can't hear or see you. But we encourage you to ask your questions. Excuse me, ask your questions through the chat or the Q&A, which is the most efficient. We have a bunch of folks coming on, so as they come to mind, please post them in the Q&A or the chat. So again, thanks everybody for participating as usual. You're going to find this super interesting, I'm sure. So, Tom, I'm going to hand it to you. The little background.
Great. Thank you, Arthur. Um, Look,
Did I
thanks
do
everybody
that
for
the
taking
right
the
way,
time.
Jake? Did I go out of sequence?
You did it perfect, Arthur.
Okay.
Beautiful. Beautiful, beautiful. Thank you. Thank you for the time. So Jake and I are going to spend, the next, hour or so convincing you guys that we built one of the best risk-adjusted B note investments you can find, and we're truly believers in it. Um, what I tell folks, and I know there's going to be a lot of questions. We're going to walk through the details, but I think the way to frame this and think about it is like there are a lot of ways to earn a 12 to 15 IRR in this world, right? Especially for the folks on this call. But there really aren't that many that are as risk adjusted and protected as what we're going to show you guys, and we'll walk you through it. And so, I believe that, Jake believes that, and it's pretty compelling stuff that we've been working on and building over the last year. So, anyways, um, a bit about myself. My name is Tom Bensavango. I started out as an investor in real estate in New York City, buying and selling multifamily buildings starting around 2007. First with my own money on my own account, and then investing along the way with some individual partners, then some institutional funds. Took some partners from the Lehman Brothers estate post bankruptcy, and did a bunch of deals, and really kind of learned the business in a sense, through those guys and doing those deals. Um, I found over time that space was getting crowded around 2017, 2018, and started diversifying into different structures like preferred equity, like mezzanine investments, B notes as well, um, which was a way for me to sort of diversify and structure into different kinds of investments. And I found it to be very compelling. And as I said earlier, the multifamily space was becoming crowded and expensive in my view. Um, my timing on exit of these buildings was probably quite good, but my timing into some of these preferred and mezzanine deals into 2019 was maybe not so good, right? Going into COVID and rising rates, right? And so investments that I thought, at the time that I felt were very protected from a basis and structure perspective were really in jeopardy, right? And some remain so still today, right? And the elements that all these investments shared in common were two things, right? A basis that was too high, right, north of 75% of value, right? And time, right? Like often with deals like this, you don't have the benefit of time when you have a maturity, staring you in the
Looking you in the
face, right?
face. Yeah. Yeah.
Yeah, that's right. And so it was time and maturity that really caused a lot of pain, and maybe a lot of folks in this call can relate, right? But COVID, going into rising rates, stabilizing properties took longer, refinances needed to happen, and all of a sudden I realized, hey, I'm in the equity in these deals, whether I thought I was or I wasn't, right? Now I would say there was one exception, right? There was one deal that was an exception, and it was a senior care facility that I had a preferred equity investment in Florida. Um, and we were able to work with the sponsor and work with the existing lender to structure a refinance using an instrument called CPACE financing, which is, our presentation is not going to be a CPACE, but CPACE is really kind of, I would say, the inspiration for the product that we're going to walk through today, because it has a couple of superpowers, right? Which is non-acceleration, right? It's a 30-year instrument, right? Um, and uh, and we used CPACE financing to negotiate a restructuring with the existing lender and to buy time on the investment. And we were full, the investment was fully repaid, fully recouped, and that senior care facility continues to operate today. And so it's a real eye opener for me, this CPACE thing, right? Like, this is very interesting, right? And so my partner and I decided to explore that. And at this time, this is when I met Jake Baker, who he can introduce himself, but there were a lot of synergies and a lot of green and a lot of light bulbs going off in the utilizations product, and meeting Jake and understanding how he views it, and some of the superpowers that we can use from PACE to incorporate into other products. So I'll pause. I'll let Jake introduce and speak about himself. He's very eloquent, and I'm sure you'll find him compelling.
Great. Awesome. Thanks, Tom.
Thank you.
So delighted to meet all of you and to share our story. We are Northfield Capital. We are, on the lending side, a specialty finance company for commercial real estate, making secured first lien loans in commercial real estate. On the capital side, we do two things. We create an investable, high grade rated note structure for an insurance company. And that makes up 95% of the capital. And then we create 5 to 10% of the capital in an investable, higher yielding form. And so what we're trying to do, the what, is safe and scalable first lien lending in commercial real estate from 0 to about 50% loan to value. And this is an area the banks have traditionally played in. It is a very active area, often called A-note lending or back leverage or note on note, that 0 to 50% position. Second, what we're making different, the how we do this, is with passive, long-term, well-structured insurance company financing. That's the $90 to $95. And then lastly, the why is we create high yield, risk adjusted investable tranches. We sometimes call these a B note with the insurance as an A note. You may also hear us talk about our lending as an A note, because often we are serving as the leverage for what Tom described at the 70, 75, 80% LTV level. We enable the other lenders, and that's what the banks have done, and what we're now creating with insurance company capital and with private capital. So safe, scalable first lien lending, 0 to 50 LTV, enabled by well-structured, safe, passive, long-term insurance company capital, in order to create an investable, higher yielding position that is protected within the overall first lien structure. As a little bit of who, my personal background, and I'm delighted by what Arthur and the team have put together, is I'm blessed to come from a real multi-generational family that has been able to steward what my great-grandfather built. He launched a very large cotton trading company, Anderson Clayton, when he was just 16 years old, starting his first business. And so I've seen over the years personally, both in my own investments, in some charitable organizations we are a part of, and in the received wisdom of previous generations, how careful you have to be, how protective you have to be with debt, but also the role that higher yielding and income focused investments secured by high quality real estate can generate strong outcomes. My personal journey was initially at Deutsche Asset Management, the arm of the investment management arm of Deutsche Bank. We did the last private equity style fund going into the financial crisis and the first one coming out bank wide. I then went to Starwood Capital, the global real estate investment firm, and as a managing director, ran the desk for the product Tom described, CPACE. This is a structured commercial real estate lending product. And it was there that I met literally the most interesting partners in the world. I am going to share just how interesting the three partners I have are. Tom is the least interesting. He's only a former professional cyclist who raced in the Tour de Thailand, the Tour de Peru, competing against Tour de France riders, while also performing and earning a living in New York City as a professional saxophone player. Somehow, in his time, he built a real estate investment company and development company that worked with the former partners at Lehman and other institutional investors. Our partner, Brendan, who normally is dealing with his six future multi-generational investors, his six children living in San Francisco, almost became a silent Franciscan monk, having been at U Berkeley on the law review, clerking for the best judge in San Francisco. And instead of pursuing his faith in the monastery, he ends up becoming internal counsel at a structured credit hedge fund, getting hired by a company that we invested in at Starwood, where I served as a board member, and joining us as a partner. And our fourth partner, Caleb Stokes, got into finance the old-fashioned way by being a professional opera singer who trained at Yale.
Nice.
And it turns out actors go work in bars back when you could smoke indoors in New York City, but opera singers protect their voices and work at Morgan Stanley and Goldman Sachs on the global capital markets desks. And because everyone got fired in 2007, the low-paid opera singer was kept on for a decade working at global capital markets. And so we've all come together with these unusual and interesting backgrounds. Myself directly in finance, Caleb in finance, but also performance. Tom as a competitor, as an artist himself, as an investor, as an owner. And what we're really building is the best risk-adjusted lending for borrowers and our co-lender partners, 0 to 50 LTV, first lien, senior secured lending, and also the best possible financial product that we ourselves will invest in on every transaction. We are building the instrument we aim to invest in over the long term because we see its risk adjusted to potential across transactions. Now, I've just lost lighting because we're also an energy efficient company. I'll flip that on when I turn it back to Tom. But what I want you to hear at the front end, we have two types of ask and two types of roles. One ask is that we have near-term transactions, very strong transactions, earning in the kind of 12% target return range as a result of the pricing and the financing. Those are investable transactions closing in the next 4-6 weeks where we could have participants join. We also want to talk to many of you about the longer term programmatic investment opportunity. And so that's more of how do we do multiple deals together. There's room for participants over time programmatically, and there's room for organizations and individuals who would be interested in leading transactions. And we have an enormous amount of information. These first two transactions are being led by the former head of the fund where Brendan worked as counsel, a Goldman Sachs mortgage trader, a retired owner and operator of seniors housing facilities, buyer of distressed notes, a very sophisticated guy. We're happy to connect with him and help share the structure. But we also want to talk programmatically and talk about how to target. We really believe in the risk adjusted profile, and we're excited to share some materials with you and to follow up afterwards. This is a really wonderful time. I'll pass it to Tom and turn the lighting back on. Thank you.
Yeah, good. Mandani's trying to feed the
He's
rest of the
cutting the
population by sucking up your electricity.
he's cutting the power. Arthur, I mean, do you want to pause for questions? Like we can continue on.
So I think what would be helpful before we jump into the deck is your insurance company's got and I'm going to screw this up, but just let me do it for a second.
Sure.
It's got a note which gives you some of the capital for part of that 50% LTV. They're expecting some yield on that. And then that's 95%, I think you said. And then, or let's just call it 90. And so if you're doing $100 million deal, they're putting up 90 and you got 10 million available
For
for
B note.
people
Yep.
for the B note.
Right.
And so because their balance sheet expectations, that the interest rate that you're paying the insurance company on that note is more like what a bank would charge for.
It's less about well, so yeah, more or less, right? I think here's there's an important concept to grasp. Right? There's a little bit of a story here, right? Prior to the pandemic, right? Like this 50% lending product has been a thing for a while, right? Everybody's heard of Bank OZK, Bank of the Ozarks, right? They were very active in this what we'd call A note lending space, right? They would only lend 0 to 50 on a construction project or a refinance or a bridge or whatever, predominantly construction, right? And Jake and I looked at this and said, well, hey, like again, not getting into pace, but some of these superpowers can be incorporated into the same product, right? What happened? Okay, so banks were predominantly in that space prior to the pandemic, right? The pandemic happens, rate goes up, right? All of a sudden, banks' balance sheets are really constrained, okay? And so they pull back from that business, right? Loans aren't getting paid off. They have regulatory capital that they have to keep on balance sheet. And for all these reasons, banks pulled back from this space. At the same time, this again, the C-PACE financing, which is this tax assessment sort of type of financing, right? It's levied on the tax rolls of properties versus a mortgage or first lien, right? Um, who's funding these loans? And these loans are starting to get big. Who's funding these loans? Insurance money, right? Life cos, like insurance cos, pension funds. And CPACE is construction, right? It funds construction. It funds like similar types of deals that the banks are funding. So like what's the difference, right? Like why now is insurance capital stepping into say construction financing, right? Construction financing is like kind of risky, right? And we realize it's rating, right? Like these life cos are buying rating, right? They are buyers of paper, right? They're not underwriting the real estate, right? They want to buy
A
rating and they're
rated note.
happy.
Yeah.
Yeah, they're happy to do so, right? This is what they
It's an
want to
asset
do.
liability matching for them too, and they're okay with a low coupon because it has to, whatever risk they're insuring, it has to match up to that actuarial, and they need
Sure,
duration,
yeah,
right?
a thing is definitely happening, right?
Yeah.
But behind that curtain. But so for these reasons, insurance has like stepped into this space. What is the difference between bank money and insurance money, right? It's duration and fixed rate, right? A bank, right? Like a bank is always going to say, 3, 5 years, we want our money back, we
Yeah.
want to pay off. Insurance life co-investors, they're happy with 25 or 30-year paper,
Yeah.
right? As long as they have that rating. And so this was and I'll let Jake speak to this because he's very good at it, but this is the thing that makes this all possible, right? Because again, it's that gun to the head. Okay. If you're in a mezzanine deal, if you're a B note investor, what do you have? You have a maturity, right, on your A piece, and so you have a gun to your head after let's say year 5, right? And this is the exact problem that I faced in the deals that I was in, right? But these life co-investors don't have that need, right? It is not a requirement on their part, and so what they're investing in is truly a 30-year mortgage, right? And we structure around that to give the A note investor, the buyer of that rating of that paper, what they want, which is a long duration fixed rate maturity. And we are able to give our B, and Jake will go into it, we're able to give our B note investors what they want, which is a 2 to 5 year investment horizon with a double-digit coupon with no maturity risk from the A side, right? And so, and Jake may have something to add, but I want people to understand like this is the thing that makes this possible, right? And it is A note and B note lending is not new; it's been around, but this is right. This is a pretty new thing, and I don't think a lot of folks have caught on to it. We spent, and it's hard too. It sounds simple, but we spent the last year really working through the structure and getting it together. And so that's like really the opportunity.
Isn't the hard part also getting it rated?
Yeah, that is hard, but that's the job, right? And
Yeah.
that's what we do, and we're working through that. On these two live transactions, these two senior care facilities in California, right? That's a big part of the work. That's what we do, right? But I'll pause. I'm sure Jake has something to add, or Arthur, perhaps you have another question or what have you.
Jake, you want
Or
to?
Arthur, yeah, I just wanted to let me turn it back to you. Just does that clarify part of your question on the insurance side, or is there more that we can address?
No, that's it. But my next question, if it's okay, was
Sure.
the balance of the financing over and above the 50% that you're providing is obviously part of that's equity,
Mhm.
whoever's putting the equity into to the project, right? And then that other piece, who's lending against that? And does that lender feel better about what they're doing in a project because you have this underlying thing that can't, aside from it being beneficial to you as an investor, you can't get smoked on it to to a large degree. Is it better for the owner of the asset to have this underlying structure in place?
Yeah. So let me situate what we're doing on the lending side. And again, I think of our business as a two-sided marketplace. One side has the lender, the real estate, the borrower, the real estate mortgage transaction. The other is the capital side, the structuring side, the investment side. On the real estate lending side, we are doing a very, very, very well proven business model. First lien lending to enable, in most transactions, another lender to take risk. Blackstone Mortgage Trust, one of the largest mortgage REITs, publicly traded New York Stock Exchange company, lends at an average of 64 LTV. They borrow at 44 LTV.
Hmm.
They borrow from banks. They borrow with what's called back leverage or A note financing. So they lend, let's say, dumb math, at SOFR 400, borrow at SOFR 250, and they earn 10, 11, 12%. We're doing the exact same thing, replacing their bank funding like a bank does with deposits. We're funding majority with insurance company capital. And we also, like a bank, like every fund, like every investment, have an equity layer, have an investment layer, a higher yielding layer. And so the bank lending model is $90 of deposits and $10 of equity. They earn about 10 to 12% return on equity. We're funding with life insurance investment, $90, and about 10 of those dollars earning a 10 to a 12. And so it is inside of the first lien, the senior mortgage. It's protected, as you were describing, Arthur, through the note structure. So that's on the capital side. The insurance company buys a note which does not have the right or the ability to wipe out the equity investment inside of our structure. And this kind of makes intuitive sense in some areas. A depositor at a bank can't wipe out the bank's capital,
Totally.
but
Yeah.
what they can do is they can take their money out. That's a
Mhm.
bank run. And the life insurance company here is investing for a very long time. So there's no risk of maturity. There's no risk of bank run where the capital gets pulled out. And as Tom described, in a lot of commercial real estate transactions with junior debt, sub debt, mezz, pref, you don't lose money on the building. You lose money because the financing is maturing. You have to pay it off. You might have to sell at a time when it's suboptimal to sell.
Right.
We're eliminating that risk from our financing, the insurance company.
Got it. So totally makes sense. The balance of the capital that's required to buy or invest in these projects, where's that coming from? And by definition, because you're doing what you're doing and the way you're doing it, does it make it easier to have that second lien position for a lender?
Yeah, well, let's describe the three categories of transactions that we will pursue. We will pursue single property new construction lending below 50% loan to cost. So there, other investors, other lenders, equity investors, the developer will provide the balance of capital.
Got it.
Second, we will refinance construction loans on existing completed buildings prior to their full lease up and stabilization. There, some of the equity, maybe some mezzanine, maybe some preferred equity will stay in the transaction. Sometimes new equity will be contributed, and we will be refinancing another lender. And then the last one, which is where some of the real large programmatic growth can come, is that we will make a loan to another lender, a warehouse loan, a loan on loan, a facility across 20 different, 50 different underlying loans. And so it's still 0 to 50 lending, but it is against the loans that someone else has made. And maybe we would be refinancing some banks that helped leverage those loans, and we're creating a corporate facility. So it's those three products. The near term transactions that we're working on that are the investable illustration are refinancing two completed seniors housing luxury Class A facilities, one in Northern California, one in Southern California. They're already leasing up 50% on one, 63, 64% on the other. We're refinancing two of the largest national banks, and the sponsor here, the general partner, is a $27 billion residential developer, multifamily developer, industrial and seniors housing developer. And the limited partner, the equity, is a $60 billion national institutional money management platform. Both are well known names, both are very large platforms. So on one, there's like 43 million of cash staying in, and on the other, there's 37 million of cash staying in. Collectively, we would be lending 95 million on two deals, not crossed, two separate deals, and about 10 million of investor capital within that. The 85 million is coming from funds managed on behalf of life insurance companies run by one of the largest asset managers in the world, literally as institutional as you can get. And so we have our existing investor capital as part of that 10 million. We can create room if anyone has an interest to participate in that 10 million. That's earning a 12 on the differential between the loan and the financing. But it's an illustration of what we intend to create and produce over time. And so the slide materials, which we're happy to flip through and also follow up and do one-on-ones, illustrate that strategy of creating the 10 million. They don't illustrate the two transactions. We have anonymized versions and we have complete and full data rooms that we can share behind NDA. But those are the types of transactions we will work on.
So this, I know people are thinking about this, so don't take it the wrong way.
No.
I think that it's clear the value, right? You have to provide value, right?
Sure.
Why wouldn't these big institutions go directly to the insurance company and do the note with them for the 90% and then worry about the rest of it? Why wouldn't somebody go direct to the insurance company and let them take the borrow the money from them directly to be?
So there's two answers to that. One is sometimes they do. We're working on this transaction. We were introduced to it through a relationship with a senior capital markets broker at Jones Lang LaSalle. We had previously closed a transaction with him. He knew the firm, he had confidence in us, and he brought us into the competitive bidding process. So they went out to the market and sourced all available financing from all available parties. And we won an exclusive term sheet with them that we're working now to close on these two transactions. We had our asset management partner, the $85 million investor, on the phone with them last week. And they said that exact question. Why are you working on this structure versus another one? We just like to understand what the value prop to you is. And they said, we love the terms, we love the pricing. Maybe there was someone a little better on one deal, but not the other. But of everyone that could do two at a time, this was by far the best on structure and pricing. The insurance company question, we're not being funded by the real estate lending side of the insurance companies. We're being funded by the asset backed security side, the ABS side.
Yeah.
That group buys rated notes in the public market and the private market. And so the real estate lending group goes out and lends to properties, but they mostly lend to stabilized companies.
Right.
Whereas the ABS team is buying at a relative value spread over what they can buy in the public market. So a publicly traded CLO might yield X over treasuries, 200 over treasuries, and they might buy from us at 250 over treasuries. To them, with the strong real estate, the low loan to value, and the incremental relative value yield, it's an attractive benefit. They're not set up to originate, but they are enthusiastic to deploy money. Our current partner here has like 12 billion that they must put out this year. I didn't mention it earlier. The one transaction is about 37 loan to value stabilized. The other transaction is about 44% loan to value stabilized. And so the unanswered, the unasked question is, isn't this something they could just go get a normal bank loan for? And what's really interesting is that a lot of the banks are less active lending on pre-stabilization. They will lend on construction for very high quality projects. I don't think this is, doesn't identify the transactions. We're refinancing Wells Fargo and PNC Bank. So very, very large institutional banks. But they are also active and stabilized. They're not as active in the bridge. And so that's where we were competitively differentiated, both on structure, pricing, and the strength of the product offering.
And the banks are suffering from regulatory, disconnect, right? There's a lot of issues with the regulators saying, wait a minute, how are you rating this on your balance sheet? So I imagine this works to your advantage in that way too.
Correct.
Yeah. All right, let's go to the deck. That was super helpful. Thank you. And forgive me for getting into the weeds a little bit, but I think it's really interesting. Yeah.
We live in the sausage making.
Yeah, good.
Yes, we do. I'm looking at the deck and we've already covered a lot.
Arthur, do you share it or should we share it?
Well, I don't have it, so let's start with that.
Okay, I'll pull it up and share it.
Yeah. I don't mean to be a smartass, but
No, that's all right.
Yeah.
All right, Tom, over to you.
Yeah.
Why don't we flip to page? I think let's flip to page 5. We've covered, the bank. Yeah, I'm sorry. We've
You always,
covered
there it is.
Yeah.
Looks good.
Slide 5. I want to talk about ARD, right? Because we haven't covered this yet, right? So I'd like to just talk a little bit. Okay, so we've kind of covered the insurance versus bank funded story, right? And why that is, and what the dynamic it's creating, which is like this 30-year instrument, right? Which is
It's super cool, by the way.
really compelling, right?
Yeah, I was
Go
just,
ahead.
again, not to get too, but are they underwriting the transaction to do this 30-year note to the extent that the other part of the insurance company does real estate lending would do?
Well,
They,
yeah, let me just
go ahead.
describe the 30-year piece, and then Tom, I'll turn it to you on the slide.
Yeah, sure.
We are making a 30-year loan, which will immediately confuse and scare everyone. That loan at year 5 has a material rate step up and a cash sweep. We don't do this to give the borrower a 30-year repayment.
Right, of
We
course.
do this so that the insurance company owns a note, owns an asset, which amortizes fully to zero. They're comfortable holding this for 30 years. They understand that it will prepay at year 2, 3, 4, 5, but it will allow them to run off for as long as they need to. There is no maturity default. But at year 5, and this is what Tom will describe, there's a rate step up on our loan and a cash sweep. So, Tom, back to you.
Thank you, man. Yeah, I mean, this is kind of where this is the page for the B note, Mez, and pref folks, right? Because maybe a lot of people are thinking like, oh, okay, great, 30-year instrument. There's no maturity risk. That's great, but nobody investing in a B note or a mezzanine loan or a product like this is interested in a 30-year term, right? And so like that makes it sort of uninvestable. Okay. And so, and Jake highlighted, right, we this is sort of a problem, like, well, what can we do here, right? And so we introduced this ARD concept, which is it's not a thing that we've invented, right? This is a thing that exists, but like Jake said, we integrate this interest rate step up after year 5, right? And look, if anybody's ever been a borrower or in the real estate space, right, any meaningful increase in your loans rate generally breaks the business, right? Like it's just not going to work if your rate goes from 8% to 12, right? Especially across a loan like this, right? Even at a low leverage point. And so the incentive to refinance is really strong, right? And so this ARD structure is really important to understand, right? The 30-year term on the A note coupled with the 5-year rate step up to the benefit of the B, right? This is what we're interested in, right? Uh, Creates a thing that gives the best of both worlds, right? This is the ARD is the thing that gives you that like 2 to 5 year investment horizon if you're in the B note, but also kind of takes that gun, that maturity risk, right? That gun to the head on the A note and takes that away. So you're getting the benefits of a shorter term investment with like with longer duration financing, right? The A note. And this is the ARD plus that 30-year ANO term is kind of the whole shooting match, right? This is the thing, this is the magic that makes this AB structure very different from I think any other, certainly that I've invested in, and probably that most folks have encountered themselves. It really is unique.
So the
And
insurance company gets their duration at a coupon that they can post to their balance sheet for the asset liability matching. And they also have the ability to increase the rate if need be.
The rate step up is automatic after year
right,
5 on the mortgage. And so the magic here is that it is not a event of default on either the mortgage or the A note. And so I see a question in the chat. Also, pleasure to see Rich there and longtime fellow traveler in the market. The loan is repaid via sale or refinance of the loan. That flows through the waterfall. So the B note might earn 12% prior to year 5, but then 18 or 20% after year 5.
Yeah.
So there is not a direct repayment obligation, but the probability is that this loan will repay in years 2 to 4, and that the step up in rate, the beginning of amortization, and a cash sweep on the loan will highly incentivize
People,
the
yes.
borrower to prepay, refinance, or sell the property. However, it is not an event of default on either the loan or the A note. The A note
From being
cannot
wiped out.
wipe out the B note
Yeah.
at year 5.
And does the insurance company get paid back at that time, or do you just roll it over to something else?
Both get paid back over
It's one
time
loan.
Yeah.
or at the moment of refinancing.
Yeah.
So it would just refinance and repay in totality, or it would amortize and cash sweep down to 0.
Yeah. Super cool.
Well, and Jake, too, another thing to think about, right? Because again, B note investors want liquidity, right?
Right.
Like these are folks that are always rolling into different positions, and so that like that again, that 2 to 5 year duration, 5 is long, right? I mean, most folks want like a 3 4 years tops, right? And so they're what are some other versions of an exit, right? Like again, Jake's highlighted that the rate step up after year 5 is not an event of default, right? So the loan is not in default. It's not distressed, right? The rate is just higher. So what do you
Well,
have now?
and
Like,
Tom, I might ask, in your lending portfolio that you've personally done, how have your loans been paid off?
dude, I gotta say, not many have, right? Just the project in Florida, right? Or that's the only
So
in
some through sale, some through refinance. I know you've had the painful experience of going through bankruptcy on
bankruptcy,
one
right?
that's
Yep.
restructured it. And then
Yes.
some are not paid off and are continuing in various states.
Well, and we'll get to this in the next slide, but a couple things there, right? So, like in this, so in the scenario where, okay, I was invested in a B note on a loan against a hotel in Williamsburg, Brooklyn, right? And the sponsor, COVID hit, and um, the she threw it into bankruptcy, right? And so what happened, right? Everything freezes, right? Time goes by, time
That
stands still, okay? And what do judges
everybody's
say? They
making
say,
money during the
except,
bankruptcy, except
correct,
for you. Yeah.
correct. You've got a
I
receiver, a servicer, right? Lawyers are getting paid. And so what's happening during that time? Payments aren't being made, right? We're not recovering interest, we're not recovering principal. Vendors are being paid, lawyers are being paid, and that gets expensive and it erodes your basis,
yeah.
right? What happens? Your basis starts eroding quick. And so I can't remember our exact basis, but I would say it was north of 75%. It was probably somewhere between 75 and 78% of value. And we suffered some principal impairment. Why? Because the process of bankruptcy is very, very expensive,
Yeah.
right? And so now compare that to this, right? Now, what I was going to say earlier is okay. Now that was a loan that went from foreclosure to bankruptcy. It was distressed, right? And selling distressed paper is just harder, right? Now, if we have a rate step up in year 6, and maybe we decide we want some liquidity, we have a B note that's earning I don't know 18%, right? On a loan that's not in default. Could we market and sell that paper? I, you know I
A lot
I think
easier.
so.
Yeah. Yeah.
Yeah, I think so, right? It's not a distressed loan, it's not in default. You have an A note that's captive, right, with 30-year duration. I think we could sell that paper. Will the borrower pay it off in 6 months or a year or a year and a half or whatever? They may, but but that to me that paper is marketable, right? And that's
Yeah.
the
And it doesn't
distinction
actually
here.
matter whether they pay it off after you've sold it.
No,
Yeah.
no, it doesn't. Right, right. My
Yeah.
point is that the paper's marketable because it's a high yield in a non-distressed situation,
Yeah.
right?
I see
Um,
in the Q&A that Cyril has posted, I'm going to read it out. The step up in rate incentivizes the borrower, but it is not an event of default. Market conditions obviously play a role here, but the rate hike does not break the asset. If equity is required, sponsors will fund it if they believe in the projects, and most sponsors will believe. The rate spike does not actually break the investment. And worst case scenario, you are first lien at 50% LTV. This is structurally one of the most risk adjusted investments you can find. Compare that to Pref and Mez, which are subordinated to Northfield. Thoughts? I am hiring Cyril as a salesperson and an originator. We did not plant him.
You
This is the
planted him here
product
for
we're
sure.
designing.
Yeah, you totally planted him.
This is the exact
Thank you for your
product we are
questions.
aiming to design. This is the exact structure.
Yeah.
Aligning incentives, creating incentivized behavior without immediate default foreclosure acceleration. It's fundamental to the way that we lend and the way that we structure our capital.
Yeah. By the way, Tom, I think I know what hotel you're talking about.
Yeah, that's the one. All right.
Yeah, it's the one.
Never do that
We,
again.
we talked a little bit about this one with the countermeasures. All of these slides will be available, and we'd be delighted to go through these and others in more detail. Let me flip through, Tom. So this is just an overview of the process. One of the things that we're doing is not raising discretionary capital where we're investing out of a fund. We have been investors. We have been capital allocators. We are stewards of capital ourselves. And we dislike giving up the risk analysis decision to another party and charging fees on uncalled capital.
Yeah.
Here, we're focused on deploying into the transaction with matched term financing. What most loan origination businesses do is they originate on a short bank-funded warehouse facility, and then they try to go out and do the securitization or the permanent financing or the loan portfolio sale. That's where you lose money. When I was at Starwood, and this is all public, the platform bailed out a fellow private equity company's mortgage REIT because their financing came due during COVID and there was no other option but to take dilutive equity.
Yeah.
Here, we're matching with that insurance company capital from day one, and we're not calling limited partner dollars. We're not asking for discretion. We want to build a robust network of relationships with sophisticated, experienced individual and institutional investors to do transactions, not fund. We originate a deal, we structure it, we place the A note. We have a network of a large number of the biggest names in the life insurance market, the groups that you see advertising on TV, all of the life companies, all of the insurance companies, some of the very, very large asset management platforms which manage insurance dollars.
Yeah.
And then we retain the B note. And that is the portion that we invest in alongside of you.
So it's really interesting. You've taken the preponderance, 90% of the LTV loan and have it credentialed by an institution that others would be comfortable following behind.
And partnering with. We really look at these as co-lender partners,
Yeah.
both within our structure and within the preferred equity, mezzanine, and the equity positions of the borrower itself.
Yeah. Does any of this pass through, like when you're investing in a sponsor in a real estate project, you can structure it in a way where the cost sag and all the other stuff, the goodies that you normally get with real estate, pass through on a K1. Does that happen here?
One of the challenges of any lending structure is that it is typically qualified as ordinary income. While we are not tax advisors, we have some friends who've moved to Puerto Rico and are able to earn ordinary income.
Indeed.
So there are strategies.
Mhm.
The value here is equity-like return with first lien protection.
Yeah.
And so it is less about the advantaged structure of real estate. My partner Tom is a real estate professional. He has done a lot of investing. I envy his abilities there. But this is a senior secured first lien position. Tom mentioned Bank of the Ozarks, Bank OZK. We like to talk about them sometimes. We admire them deeply. Bank of OZK is one of the largest, not well known outside of specialty real estate finance groups. They were lending $7 to $8 billion a year at 45, 50 loan to value. They peaked at 13 billion a year.
Wow.
Their founder has a plane and the largest house in Arkansas, lending at 45 loan to value. It is a very successful business model. And so, unlike a bank where the 40% is funded by depositors, here we're funding with the permanent insurance capital and then monetizing the equity position.
Yeah, and as there's probably endless amounts of insurance company capital that can be deployed here, because, like you said, they need to get it deployed. They're just
One
bringing
of the
in
things
premiums, right?
I've personally been involved in raising a number of classic LPGP fund structures. Raising limited partner capital is hard because you're being entrusted by your investors to have fiduciary and discretionary stewardship of capital.
Yeah.
We are funding ourselves primarily with the bond market. It is a very large pool of capital, the ABS market, the life insurance market, the fixed income market. And it's a real direct response to how challenging it is to raise investor dollars. I'll flip back to where we were.
Jake, why don't I know we've talked about bank and insurance. Yeah, I say we've covered that a lot. We've talked about ARD. I don't know if folks have more questions here. What I kind of want to talk about. Look, we talk a lot about we've there's a lot of mitigants here when it comes to maturity risk, right? We've talked about the 30-year duration with the A note, the ARD, right? What are we doing? We're giving ourselves a lot of runway with this like 30-year A note instrument, right? And this 5-year ARD on the B piece. One other type of impairment we don't talk about much is, again, we talk about maturity default, but we haven't talked about non-payment, right? And so what happens here when a borrower just stops paying? Okay. I mean, at some point you have to do
It could
something
happen.
about
Yeah.
right, and it does, right? I mean, again,
Yeah.
I've just spoke about an investment, a B note investment in Brooklyn where non-payment was an issue for years, right? Jake, this would be like, I guess, slide 12, right? But look, this is where I think that this 50% LTV rule really matters, right? So I think folks ask like, well, why 50 LTV, right? Like 50 LTV, borrowers don't want that. They want more leverage. Okay, yes, this is true, and they can go find that leverage, right? There are other lenders and other products for that. I think the real North Star here is this low basis, right? Because the low basis is the one thing that really mitigates best against non-payment, right? Because with non-payment comes impairment and then comes, litigation, foreclosure, and all these things, right? And so like what is the fundamental difference? And it's a big one, right? Between a 75% LTV investment and a 50 LTV investment. The difference is meaningful when you're in a non-payment situation, right? And so that's why it's 50. That's why our sort of hard cap is 50 LTV, right? Because we mitigate maturity risk, right? We mitigate duration risk with ARD. We mitigate non-payment risk and value impairment with the low basis, right? And again, we do all this while paying a 10 to 13% like current return on these B pieces, which I think is really stellar and kind of unheard of, right? At that basis, at that level, right? But that's really important to understand is like the low base is critical uh, from this standpoint, right? When we're talking about non-payment and value impairment over time.
You just
But
have a
Jake,
lot of room for
yeah, that's all it is. It's just
yeah,
cushion, right? There's
yeah,
nothing special. There's no magic, right? There's no
yeah,
trick. There's
yeah,
no sleight of hand.
yeah,
It's just we're creating a whole lot of cushion for things to go wrong before we actually see principal impairment in our instrument.
yeah.
One of the things that has long been the pitch is to make a mezzanine investment or a preferred equity investment and have a debt like security with an equity level return. And 15, 17, 18% returns are often pitched.
Yeah,
What is omitted is that you effectively have margin call risk. And so if you watch The Big Short, when everyone is having to pay margin and the bankers are calling and they're attempting to margin call, and anyone who's ever done a margin loan, that's what real estate lenders often have. When their loan is maturing, when the mortgage is in default and you're in a mezzanine or a preferred equity position, you have senior capital, which, if uncured, can wipe you out. And the only way to protect yourself is to buy the entire mortgage. You lent at 65, you put up 15, and you borrowed 50 in the form of a mortgage. You're still debt, but the 50 can wipe you out. And if you don't take $50 million to protect your 15, you lose all 15 million.
Yeah, it's wild. Yeah,
Here, we are inside of the 50 million and we are protected with no margin call style structure from the insurance capital. I am going to hire Cyril. Cyril's
I
wonderful.
know.
Looking back at
Sarah.
07, '08, I think it's worth focusing on how LTVs beyond 85%. We hit 99 pre-crash, and how life co's suffered heavily. I would imagine they would be incentivized to put their trust in such a product. Mathematically, this is sound. We did not plant Cyril. We would love to follow up and speak. I think the thing that we saw in particular in the crash in '07, '08. And so, when I look at, and I'm blessed to still be, hopefully in the early part of my career, but I've personally lived through the dot-com crisis, 9/11, the global financial crisis, the long recovery from that. You have COVID shutting the world down. You have the inflation and bank crisis that comes out of COVID. We now have hot war in Europe and the Middle East again. There's a lot of unexpected macroeconomic spikes. And so, what we aim to do is ride through the temporary insanity that often occurs in markets. When you look at the NAREIT data, the National Association of Real Estate Investment Trust data, this shows at a national level all of the property income and all of the portfolio value for REITs over time. The NOI, the net operating income, only dropped 10 or 15% during the 2007 2009 global financial crisis. But what happened was that the values dropped 50%, 40%, 30%. Values collapsed. The reason for that is because the cap rate, effectively the multiple, expanded during a crisis. And what we believe is during a crisis, most risk assets trade at the cost of equity because leverage flees. Credit is frozen. Banks are frozen. I joined Deutsche Bank a month to the day before Lehman Brothers went under. I joined out of a consulting firm. It was a wild time. I remember it well.
Yeah.
What you have is frozen credit markets, spiking credit spreads. We hedge this risk. We mitigate this risk by having permanent Lifeco capital from the loan closing. And so with fixed rate permanent Lifeco capital, which they love for asset liability matching, we don't have our financing spike during a crisis, and we also don't cause our borrower to spike during a crisis. And so this is part of how we think about the risk adjusted return of the profile. We have materially different capital structure while still lending at a very low, very secure level. The bank, funded with depositors, has depositors pulling their money during a crisis. It's part of where you get these rippling, rolling, overlapping problems.
Yeah.
I'm
So
glad to hear that Cyril's not a bot. I
I know
agree.
Cyril's for everybody's benefit. Cyril admitted to not being a bot, so this is good news.
It is
So
what a bot might say. I'm just
exactly,
noting.
yeah,
I
exactly. So in we know that there will be another crisis. We just don't know when and what, right? But in the one that you mentioned in 2008, for example, the coupon, let's say the cap rate was 3 or 4%, just to use an easy number, and the equity reduced by half, or the valuation reduced by half. Was that coupon on a reduced valuation, or was it on in other words, did that coupon continue to get paid at 100 million instead of 50 million?
Yeah, so let's talk about what happens during a crisis. During a crisis, banks are told by regulators to do all sorts of things to protect themselves. One of the things they're told not to do is lend any more money.
Right.
They may sometimes have forbearance and extensions, but they're accruing penalty interest, they're accruing problems. So the building might have lost 15% of its income. People were shuttering their offices. People were moving out of cities. They were selling homes. They were not going on vacation travel and staying in hotels. But the value of the building fell at a moment in time because the cap rate spread, right? In investment space, the EBITDA or price earnings multiple gapped out. The yield required to purchase real estate went from 5.5% today to 12% for a moment in time. During the savings and loan crisis, my partner at Starwood was the founding general counsel, Madison Gross, a wonderful, wonderful man. He was telling me stories where they were buying multifamily at a 25% yield in the early 90s.
Crazy.
And that's a function of the market spiking at a moment in time.
Yeah.
And so it's the yield requirement driven by fear, driven by economic, driven by macro changes, but also driven by frozen credit. We at Northfield believe it really normalizes during a crisis to the cost of unlevered equity 15 to 18%, 13%, 12%. You see risk assets blow out more or less to the unlevered cost of equity. And so you have a haircut on the real estate and you have a haircut when someone must sell a mortgage. Our structure is designed so you don't have to crystallize the loss at that moment in time on either the borrower side or our side with the insurance company capital.
Yeah.
This is just the snapshot of the whole team. I'm going to flip to the final page. There's always lots of slides, but this one includes emails. Just if anyone wants to take a screenshot, I know Arthur will follow up with this, but for the recording as well. Very happy to continue answering questions. I know we've got a little bit of extra time on our side. Arthur, I don't know what you need to do to wrap up or close out with questions.
Yeah, I just have hard stops, so I'm going to have to wrap it up. But we could probably talk for another hour. But sorry about that.
We're delighted. Thank you so
Yeah.
much for including us.
Yeah,
Yeah.
no, it's
Thank
been
you very
awesome.
much. This has been great.
Really, really fascinating stuff, and thank you to everybody, including Cyril, not the bot, to have some thoughtful questions, and everybody joining us today. And like I said, if there's anybody that you know that would also benefit from what you benefit from today, please feel free to make sure you get in touch with Tom or Jake, and we'll facilitate that.
We've spared you Tom's last name and his email address, but I'm married to a beautiful fellow Italian woman. And so it's tom at nf-cap.com. And I'm jake.baker at nf-cap.com.
Yeah, awesome.
Thank you all so much. A real pleasure.
Thank you for doing this, guys. And thank you, everybody, for being here today. Till
Thank
next
you,
time.
Arthur. Thank you, everyone. I
You're
appreciate
welcome.
it.
You bet.
Have a good one. Bye. Take care.